And we're live for another TNT State of Startup Investing. I'm Jesse Weeb, your community development lead here at Startup TNT, coming to you live from Saskatoon, Saskatchewan, where we are across all of Western Canada. And it is a privilege here to share an update with you on where VC is at in Canada, in the US, North America, and some of the trends that we're following from one session to the next, and giving you a quick update on where things are at. Um, we are able to do our work here at Start TNT thanks to the generous support of our partners and sponsors. TNT is funded by Innovation Saskatchewan, Alberta Innovates, and Praise Can as our core funding partners. Thank you very much to those folks, as well as API, our partner on the upcoming Life Sciences Summit. We got Osler as our BFF as well, fantastic law firm across Canada. We also have AC, Bose, CBRE, Fasken, Recursion, and MNP as our best friends. Thank you to all of them and some awesome folks here as close friends and community supporters. All of this folks are what make the startup ecosystem possible here in Canada, and we thank them a lot. You'll be seeing some information from some of these partners throughout today's presentation. So before we get started, just a quick check-in on where we're at with TNT so far in 2024. For those of you that don't know, we've done 7 investment summits so far this year. 3 sector summits, agri-food, clean tech, and life sciences in Q1. And then in Q2, we had our 4 regional summits, including Manitoba, which has recently been put on pause. So we had Edmonton, Calgary, and Saskatchewan alongside Manitoba. There were 18 summit deals done between those summits, but we've also done 5 follow-on deals into our existing companies. So you got 2.99 million invested. And then there on the bottom is a breakdown of the types of deals that we're doing in our summits, predominantly safe investments. And as you'll see later in the presentation, safes are becoming very common these days for our early pre-seed and seed stage rounds. And that is a trend we've been following for quite a while. In total, TNT has invested 15.8 million. You'll notice 2025 on there. We run on a fiscal year of July 1st to June 30th, as you see on the bottom. So technically, we've done some deals here in the later part of the summer. That is in fiscal year 2025. So 15.8 million invested across 100 plus companies. We're very excited to have crossed that $15 million mark in 2024. And what's the breakdown here of where those companies are located? You'll see a big chunk of those companies are in Calgary, as well as Edmonton. But Saskatchewan has been doing pretty well with 3 years under its belt and 26 companies invested into. Manitoba has continued to lag, but we were really excited to see 3 deals in the spring, and we're looking forward to seeing some more deals next year. And we've got a few companies from outside all those jurisdictions that have come through some of our older summits that are now technically in other jurisdictions. And quick update on our impact. Based on our most recent portfolio update, we're actually currently undergoing another one. We've run 37 summits, over 450 angel investors activated. Some of those were, well, I would say about half of those were brand new to angel investing and had never done angel investing before. And we were really excited to have them participate in our summits and do their first angel investment. And they have since gone on. Most of our investors have done multiple investments through our syndicate. You'll see here a lot of our companies have seen annual revenue increases, number of jobs added. We are investing at the early stages, so they're taking that money, they're moving forward with it, they're hiring more people. We are going to be updating our portfolio as you speak, so we're interested to see where that trend will go as we go into the rest of 2024. Companies have started to hit some of the problems in the market with a lack of capital funding, and we'll get into that here in just a minute. But first off, where did we leave off? We did our last State of Startup Investing. We do these twice a year. And just want to give you a quick update on where we left off in Q1. It was in April when we presented last. So this is what we were looking at coming out of 2023. The CBCA report showed a decent 2023 at 6.9 billion. If you actually go back historically, you'll see that it overall is quite good, and we'll see on the next slide how good that really is. But the height of 2021 and 22 had started to fade. We're starting to get back into, maybe a new normal, but not nearly quite as high as 21 or 22. And if you look back even further, thanks to our friend Matt Roberts over at Command Capital, he's been in the ecosystem for quite a long time and has had the privilege of being able to acquire all of this data here on how much historical investment was coming in venture capital in Canada. And as you can see, barely cracking that $4.5 billion mark for many, many years before we achieved a new normal here in 21. Rising quite high, and we're seeing some good numbers coming out of 23. So we'll be interested to see where we are so far in 24 comparatively, and are we starting to continue to see that new plateau hit? As well, PitchBook was talking about how the venture deal making indicator was showing investors really controlling the narrative with a lack of capital available and the ecosystem dropping valuations overall. Investors started to control terms. We were also talking a lot about down rounds, which are related to that. Osler showed a significant number of flat rounds or down rounds in 2023, and so did Tories. So this data was certainly being seen across the board. So investors were obviously controlling where the valuations were going, and the startup founders weren't having nearly as much of leverage to be able to push back against it. We certainly saw that in some of our own deals. There's been some significant drop in valuations over 2023. And here you'll see majority of that was actually happening in the later stages, even though we were seeing some of that in the stages that we were at. In overall, 2023 was particularly harsh on some of the later stage rounds, which is quite understandable considering when those companies would have raised their previous rounds, typically about 12 to 18 months, if not 2 years, depending on the market, which means these companies were raising in 2021, meaning that they were raising at the height of the market, overpriced valuations, those started to come down. It all made a lot of sense. And we were also starting to see a lot of time passing between rounds, which is certainly what we've seen here at TNT as well. Some of our companies just now are coming up on their 2-year mark and are starting to go out and try to find the next round of financing, and are seeing it taking a number of days to put the round together, on top of the fact that they've had to spend a lot of time trying to achieve metrics in a tight market. It's harder to sell, it's harder to achieve metrics, and that's certainly what we were seeing at the end of 23 and in the early part of 24. Also, rounds were taking multiple closings. So they're taking longer. We've seen that as well in the early part of 24, with a number of our companies experiencing multiple closings on their the rounds of investment. And overall, then, and you can see here in Q1 of 24, there continued to be a quarter-over-quarter drop in the global venture financing, and we were finding overall seed and angel investment in the early part of Q1 of 24 had started to drop. Exits were still top of mind in early part of 24. At the end of 23, as you can see here, not a lot of M&A or not a lot of IPO activity, a decent amount of M&A activity. That's predominantly been where things have come from. But as you can see up here, a lot of the exits were coming from only a few deals. And continued over here, exit activity has dropped off, which is certainly an interesting trend, and we'll get into what BDC's numbers relate to that in just a minute. The other trend that we were watching, obviously, is an M&A in the US. So here's the M&A activity in the US, which had started to come up at the end of 2023, but overall have been relatively flat. And we are looking forward to seeing the data here in 24. And overall Canadian activity, M&A activity had dropped off in the early part of Q1 of 24. The other trend that we like to watch is the employment market, which is in the early part of this year had continued to see a lot of layoffs. Startups had been making a lot of cuts in order to extend runway and make it further. And in addition to that, with the advent of some of this AI technology, they had been able to run a little leaner teams. So some of those layoffs have continued to remain quite sticky. We were a little worried about our interest rates, wondering where the capital gains tax changes were going to take us. And overall, we're kind of worried about this venture market slowdown. That's where we look at in the macro conditions. And then, of course, we were looking at where AI was headed, how the tech talent side was going to go, and overall where generative AI was going to play in with some of the policy changes and potential legal problems as well. So, what has changed since then? What other data has we gotten since we looked at this state of startup investing the early part of the year? Well, one of the most interesting reports was the BDC Canada's Venture Landscape Report, which kind of put things into more context on where Canada lies within the wider OECD country landscape. Canada is currently sitting eighth in the OECD in the percentage of GDP from our VC investments. Certainly a long ways to go, but not nearly as bad as I might have thought. In the grand scheme of things, Canada has been notorious for historically for not being a place to raise venture capital. But certainly, when you put things in perspective here, you can see that we're not as bad off as you might think. Certainly a ways to go, though, if you're comparing that to a relative scale to the US, which is more than double our share of GDP. And if you break that down across the country, we're most interested in what's been happening in the prairies. As you can see here, 23% over the last few years of our GDP has been invested in venture capital investments, which is pretty sizable. BC is now a part of the TNT community, and you can see here has been holding pretty steady at only 13 or 14%, which I think is a really interesting number to look at, especially when you start to see how 2024 has shaped up, which we'll look at in just a little bit here later on. But still, it's relative to Ontario and Quebec, which are the two strongest ecosystems for VC investment in the country. We certainly have a ways to go there. But often one of the things we talk about in the prairies is how we punch above our weight class. And looking at a 23% GDP share into VC investment has certainly got to be a reason why the prairies are punching so high. Overall, one of the other things that came out of the BDC report was a further breakdown of the down rounds through their direct portfolio. They have a number of investments directly in startups through BDC Capital, and 31% down rounds in 2023. I think that really plays into what we were talking about earlier with all the other data sets. That overall 2023 was a tough year for VCs. For startups trying to raise VC. And we are starting to see some of the ramifications of that now as companies are continuing to raise, and we're still seeing down rounds happening or flat rounds. So certainly something to think about as you're going up to raise is what are you trying to set your valuations at, and are they reasonable expectations considering the current climate? The other big thing that came out of the BDC report, this is Bryce Shashuk, a recent presentation of a new presentation of his that we're going to talk about near the end of today's presentation, all about the mighty middle. But he's talking about the value on paper of your company or of your VC funds, right, an RVPI or TVPI. And then DPI, which is the distributions on invested capital. And the BDC report really highlighted where Canadian VC is actually at. This is one of the most interesting breakdowns I've seen in recent years on the Canadian state of Canadian BC. So I really wanted to highlight this, even though it's mostly 20 up until 2023 data. Um, you can see historically that even on paper, the best percentages from Canadian VC are not that high. Um, 3x is fantastic here from the 2011 to 2013 vintage, but you're seeing barely cracking one on paper from some of those most recent vintages. It does take time for them to get there. Overall, it's only been, 5 to 7 years. But even here, this is pretty low on TVPI, which again is only on paper. So when you look at DPI, which is really what matters, you can see it's even worse. Um, Barely cracking over one, only in the upper quartile, in terms of actual returns. This is a perfect exemplar of what is happening in the Canadian market right now in terms of a lack of liquidity, right? If you're wondering where the money is, why VCs aren't maybe deploying as quickly as they used to, a lot of it has to do with a lack of liquidity in the Canadian market, and this is in large part due to the DPI across past vintages. Right. So without this low of distributions, with only 2011 and 20 prior to 2013 achieving above a 1x on their DPI, that means they haven't even gotten their money back yet, which means it's difficult for them to invest in the next fund, which means it is a bit of a tough environment to raise capital. And here's how the overall returns have done across Canadian VC. Not the greatest over recent years, but certainly still, market-beating returns in that upper quotile. It's been a tough game, and again, without the return coming through distributions, it is difficult to understand exactly where the IRR actually is historically. This is to be expected. This is kind of an outlier. In the early part of a fund, you expect to see a low IRR, and then it kind of corrects itself over a period of time. But I think it's important for us to look at the truth of what's actually happening within the Canadian VC market and be realistic about where we're actually at. Sorry, just seeing the chat now. Got a question on, are we sharing these slides? Yes, I will absolutely share these slides after. And then, when we're talking about the lack of GDP growth, this is actually a little grim in terms of our where we're actually at. So certainly need to see more investment flowing into the Canadian market if we want to continue to have a functioning innovation economy. Unfortunately, due to the liquidity from the existing investors, we're going to need to create more investors within the wider economy. Why is in Canada number of companies number requires not big enough swings? From the data that I looked at, a lot of it has to do with it's the lack of acquirers. We'll take a look at the data for 2024 so far on exits. It seems like a large number, but it's really just two major exits. And one was a large pharmaceutical company at $3 billion, and then the other was at 260 million. And that's just for this year so far. And if you go historically, that's kind of what happens. It's a few small mega deals, which really doesn't spread the wealth out very well. And with an IPO market, you can't break liquidity that way, which is making it difficult. There's plenty of big swings out there. There are some large companies that are currently sitting still in the private market. They just haven't been able to find a way to get liquidity for their investors. Prime example here in Saskatchewan is Vendasta. They're achieving a run rate of between 100 and 200 million ARR, but still have been unable to find a window for liquidity for their investors in over, I think, 13, 14 years now. So certainly have still a lot of work to do to be able to get some more DPI into the market. And that's just one example. You've got a whole bunch across Western Canada and especially out east. Prime example, if you look at Real Ventures portfolio and the companies that they have there, they've gone what they call a zombie fund, which means that there's basically no new investments happening out of their fund, but they are still having to manage their existing funds and are entering year 11 and 12 of some of their early funds. Which, if, for those that don't know, VC funds operate on a 10-year cycle, meaning that if they're having to extend beyond that, that's because they haven't been able to return the capital yet. It was a tough market coming in. Like, if you're looking here at 2011 and 2011 to 13, if they're expecting liquidity in that 7, 8, 9, 10 years of their fund, that's entering into this market right now, which means they're trying to exit into this market, which makes it even more difficult since the IPO market has basically dried up since the early part of 22, even within 21, to be honest. This is an interesting piece of data here. We're actually planning on working with Charles Plant to do some data analysis of our own investments, so stay tuned for that information. But this is from Charles Plant's blog. He works with the Narwhal Project, which is all about investigating how we get Canadian unicorns, or narwhals, if you will. And this is a model return of various angel groups across Canada. You can see here only a couple are expecting kind of in that higher range. A number have struggled recent years. Again, this is going to show what some of the current and existing angel groups are struggling to find additional capital to invest back into their own companies within their region. Thankfully, out here with Startup TNT, we are creating some new angel investors. That's kind of a big part of what we do, and so that's why we see a lot of funding opportunities. You'll see here exit counts over the years from different parts of the country. Again, you'll see why the Prairies has been struggling of late. BC's had some great exits. I've talked to a lot of folks over there in BC, and they've done very well on exits over the last few years relative to their size, and hopefully that will lead to some of that money flowing into our upcoming BC investment summit. We're looking forward to seeing that. One thing to note, actually, historically speaking, Atlantic Canada has had some of the biggest exits in the country. So certainly not a market to be slept on when thinking about where exit valuation comes from. Thinking about our Canadian funding opportunity, this is from the AEC Deal Flow Report that also came out in the early to mid part of this year. And you'll see that a lot of the companies in recent years have still not been able to raise much more than $1 million. At TNT, we aim to invest in $250,000 to $2.5 million rounds. So certainly lots of room left to invest within the current vintage. So we see there's lots of opportunity in the Prairies for investment. This is Alberta centric, but you think we can large enough data set there that you'll see very similar data across Saskatchewan and Manitoba. This is an interesting part of the survey that they did as part of their report. Where you see the main reasons why they say that there have been unsuccessful fundraising. A big reason why is a lack of access to investors. There's always going to be more startups, I think, than there are investors. Unfortunately, there's lots of people with great ideas, but not nearly enough money to fund them. And trying to communicate that to them in a way where you can either show your traction or just communicate that story and that vision can be difficult. So those are some of the big struggles that the startups have been having over the last couple of years. Of course, access to capital and funding, again, one of the biggest challenges that they face, next to market access and putting together a strong sales team and technical team. So for those interested in exploring opportunities in the prairies in the sales side and the technical side. There is a lot of room to run out here by working with these companies. Certainly something we've been seeing with Startup TNT as we go to different conferences across the country. There's a lot of folks interested in exploring service offerings to the prairies. So don't be afraid to reach out to other markets to see what they have in terms of service offerings for you, or if you're one of those people interested in doing more work in the prairies, we're ready to have you. So, how is 2024 going so far? This is the heat map breakdown from the CDCA first half of the year report. Biggest highlight, I think, for Startup TNT is Alberta at $383 million, 100 million past British Columbia for the first time. BC is in third place in the country. This is obviously a big day for Alberta when they saw this report. I know I saw it overall all over my LinkedIn feed. The other side that is interesting, only a few deals done and only one deal, effectively zero, done in Manitoba within that same time period. We know some things are underreported, and there's certainly a lot of work to be done in Saskatchewan, Manitoba still. This is not discouraging, but certainly shows that there is room to run. And as Will says there in the chat, Clio out in BC just raised 900 million. So the next quarter report should probably show a much larger bubble over in BC. But that does go to show, that a large portion of these dollar numbers typically come from only a few deals, from a few mega deals. And the majority of the mega deals are happening in those larger, more established markets in Ontario and Quebec. And BC with some of those companies when they do come around. That is also the reason why, if we were to go back historically in Saskatchewan, you would see numbers in the hundreds and 200 millions. When Vendasta raised their round before, instead of going IPO, they raised over 100 million. Seven Shifts went on to raise over 100 million from SoftBank as well. So both of those big deals put Saskatchewan on the map pretty considerably over the last few years. That we are seeing a pretty significant drop now to 3 million in this most recent report. So something to bear in mind whenever you're looking at these reports is just understanding what portion of the overall dollar number is actually these mega deals that are happening and overinflating the market. So if you actually look at a report from other sources, here's the KPMG Venture Pulse from the Q2 2024 report. You'll see that overall there was a tick up between Q1 and Q2. And we have seen still a pretty steady number of overall deal counts still being done for that time period, which is almost identical to the data coming out of the CDCA. So we're seeing two data points here that are very similar, with the sizable amount of deals being done, which goes to show that somewhere around that $2 to $3 billion mark is what we're seeing in the first half of this year, 3.6, which should put us on pace to ideally be around our 2023 numbers, which again, quite sizable over historical averages. So I think we're starting to see a new plateau for Canadian venture capital, which will be really interesting trend to watch over the back half of this year. Here's a breakdown on where that money flowed to. Obviously, a lot of deals being done in BC and Alberta, as we mentioned, only a few being done in Saskatchewan and Manitoba, and only a few of those reported. Again, we did not report all of our deals that happened. Those happened in July and August predominantly. So we're going to be adding our own to this title coming up pretty soon. One interesting trend to watch here is AgTech lagging. This came out of the PitchBook NVCA Venture Monitor report out of the US. Sizable decline in AgTech funding over the last part of this year, or the first part of this year. with only $1 billion total invested into 98 deals in the U.S., on pace to be one of the lowest years in record, which, sorry, I have it coming up later. I got this slightly out of order. Where were they? Can't find it. So I had a breakdown here on the Canadian sectors as well coming up, which will show that in Canada, this same trend is happening here as well. Valuations overall, though, have started to rebound. We saw a much higher average winter valuation this past year so far, with average deal valuation overall. That's including both winners and side deals, still coming up higher than the last couple of summits. We don't know if that's a blip or will continue to be a trend. We'll see this fall. That's be one of our other trends to watch. But if we're looking at overall where valuations have come, they have started to come back up over the last quarter in the US. And this is from Carta's data, great data set. I highly recommend you read some of their data. Of course, it is in US terms, but looking at trends and seeing that their data, is matching ours, certainly gives some veracity to what we're seeing. And down rounds have started to decrease, which is another way to look at it. Their overall percentage has come down considerably in Q2, as we're starting to see companies that raised pre-seed rounds in 2022, raising in 2024, as opposed to companies that raised in the height of the market here, coming to raise in 2023. So we're starting to have punched through some of those down round companies, and hopefully we're going to start to see companies that have obviously achieved their metrics raising in 2024, Q3 and Q4. Here's the slide I was talking about with the sector breakdown from the CVCA report. Where's the money going? So a couple of interesting points to look at here. Obviously, ICT, AI is still very hot in the Canadian market and in the US, with AI and ICT related companies receiving a majority of the investment in venture capital. Life sciences is doing quite well, and actually clean tech is on pace to be a record year of investments, with over $500 million already invested, nearly 600 million invested in the first half of this year. If that pace continues, that would beat last year's by a decent margin. Though the number, as I mentioned, that we're watching right now is that incredibly low number in agribusiness invested in the first half of this year, quite lagging in the US, as we saw earlier, and even worse here in Canada with only 14 million invested. Last year, we were doing in that 260, 230 the year before. So that is a sector that we're certainly watching pretty closely, and we're looking to expand our agri-food program in the early part of 2025 in hopes to drive some more investment into the sector. What else are we seeing in terms of sector breakdowns? Looking at the US market, we've got seed stage round sizes starting to come up in SaaS, while dropping in healthcare, increasing in consumer, and decreasing in fintech. The amount being raised has come up overall in SaaS, which we expect to see with some of those AI-enabled tools. Health tech is still struggling along with consumer and fintech to remain at the high levels that they saw in 21. Employment market, the the numbers have continued to fall over the last few quarters, few months, I should say, in the early part of this year. And number of folks that continues to leave by choice from their companies, while layoffs have dropped, but new hires have not risen nearly to match the pace of those that are leaving. So uh, certainly a lot of give still in the employment market. We expect these numbers to be very similar to Canada. It's something that we've certainly seen within some of our own companies with difficulty maintaining runway. Others, on the other hand, have been able to raise capital and hire more and more folks. Would be interested to see where these type of employment numbers break down at the end of 24 for Canada. And overall headcount over the last several months has remained relatively steady across all of Carta's companies, and this is in the U.S. data, just showing to show that net neutral is what we're basically seeing within the tech sector. Again, we expect that data to be very similar in Canada. A lot of folks that work within the Canadian market often work for U.S. companies. So with a freeze in the market like this, there would be more give and availability of talent. Of course, they have to have the capital in order to be able to hire and work with those companies. So it's kind of it's a tough position to be in when you want to grow and scale, but you don't have the resources to do so. Again, we are absolutely praying for exits in the Canadian market. You'll see here, looks like a sizable number, as I mentioned earlier. This exit was predominantly a large pharmaceutical exit to AstraZeneca in the close to $3 billion mark. And then there was one more exit. So majority of the dollar value coming from just two exits with 21 other exits in the sort of the small to medium size range coming in for the rest of the value. And zero IPOs in the Canadian market so far this year. So with that, again, the DPI for those funds coming into maturity now here in 2024, those that were raised in the 2011 to 2013 vintage are absolutely struggling to find liquidity for their investments, which I think is leading to a large number of secondaries happening. At some of the conferences I've been to, there's a number of folks from the secondary investment banking that are seeing folks selling off their VC allocations to other investment arms or private equity firms, hedge funds, and the like on the secondaries market. And that's in the US predominantly, but I'm sure in Canada there is some of that happening as well. So lack of liquidity still part of the story that we're following into the end of 2024. And if you look at where the exits are, as I mentioned on that previous slide, 21 of 23 exits were accounting for the deal number, which means that a large number of exits are happening in that seed and pre-seed stage that started to creep up over the last couple of years here, especially in those earliest stages, taking a quick exit. That's certainly a model that we've started to explore ourselves. We're talking about the mighty middle here a little bit later on for a company to exit in that mid-market. We've heard of exit opportunities being proposed to some of our companies in that $10 to $15 million range when they're still achieving that $1 to $2 million of annual revenue. So not unheard of to be seeing these sort of acquisitions, and certainly something to keep an eye on and something to consider considering where the market is at presently, if that type of exit might be right for you or your portfolio. So what else are we looking at in 2024? As I mentioned on that previous slide, we're looking at a different model of investing potentially. This has been espoused by Bryce Shook. He gave this presentation on the Mighty Middle at the Uniting the Prairies conference this past year as a keynote. It's a great presentation. Highly recommend you check it out. I will try to post the link in the chat there for anyone who's interested to watch the whole thing. just a different way to look at how to build a company. And there are those companies out there that are extremely VC backable with a high potential and can create that crazy wealth gain. And then there are those in the lifestyle side. And typically we've only thought about those two, but really they're endpoints on a spectrum where you have companies in the middle that can return a sizable amount of capital, potentially a life-changing profitability. So this type of framework might be something that Canada might consider, considering where our DPI and lack of liquidity is at. Are we able to build the type of companies that can go IPO and return huge amounts of capital like a Shopify to all of their investors? Or are we able to build those companies that raise capital at a 3 to 5 million valuation and sell in that 20 to 25 million and up range, and instead everybody walks away with a 5x on their money. So that's the type of strategy that is certainly being explored by a number of investors in this country, with Bryce being one of the folks leading the charge on that. Something that certainly be interested in exploring throughout the rest of this year and into 2025. Thanks, Jeff, for the comments there. Yeah, without ZERP, I'd bet more on the middle. Yeah, it is a certainly tough environment, and in the middle, here's a little bit more about what the mighty middle is looking for. They are much more prevalent. We certainly will say that we see a lot of mighty middle companies within the TNT applications, but they still do have the potential to scale and achieve that profitability that can be quite life-changing. I'll have to say that investing in these companies can be a little easier. I'm sure that actually we've invested in some already within the current portfolio, and we're looking forward to getting a bit of a data breakdown, as I mentioned, from our friends at the Narwhal Project. And hopefully that they've got that higher probability of success. Again, highly recommend you check out Bryce's presentation, as I posted there in the chat. You can also find Mindframe Connect, Founders Play Your Own Game, as it mentions here at the bottom. Watch it for yourself, and if you'd like to talk a little bit more about it, feel free to reach out to us. We'd love for you to join the conversation about this new framework. Other trend that we're seeing here going into Q3 of 24. This is from PitchBook's Venture Deal Making Indicator. We are starting to see a swing back in deal making power towards the founder. Some of the more prevalent terms that were being pushed by investors also have started to come down. There were a number of charts that I saw going through my literature review showing that like higher preferred share, liquidity preferences, your participating, non-participating shares were starting to come back into to normal levels, and any sort of those sort of weird and wacky terms that can give more power to investors, like control of how much debt the company can take on, the salary, all of that, additional board seats, and the like, have started to come down in usage rates over the past couple of quarters. So we are seeing investors coming back into line in terms of where the leverage lies between startup founders and investors, as some of these companies that have gone lean have started to be able to actually achieve profitability, or at least positive cash flow. A tough time, a forest burn can lead to new growth, and some of these companies have started to see that, which is giving them more leverage going into the later half of 24. And again, though the number of investment has declined in the US, especially in that earliest part of the investor spectrum. So this is a trend that we're going to continue watching. We did see, again, 3 million invested so far this year, which is on pace to be one of our best years with TNT, with 16-ish million raised over the past 4 years. So we hope to see a good trend through the back half of this year in terms of how our angel investors are reacting and raising over $1 million this fall. Another big trend we're watching amongst our friends. This is from the BDC Venture Capital Landscape Report again, which only was up to 2023, but there was a sizable amount of dry powder for Canadian VCs. They estimated the $10 billion make from their own sources, but I expect that to potentially be even higher at this point. And if you look at some of the big headlines over the last few weeks and months, you'll see a number of funds raise capital in a very tough environment, have been able to close funds at even beyond what they expected to raise. With our friends at Tallgrass Ventures raising over double what they expected in the ag tech space, we hope to see that that ag tech number start to float back up as they invest alongside some other investors from both across Canada and into the US and even outside the country. As mentioned, clean tech and AI have been two of the hottest industries in the last year, and you see that exemplified here in these two funds raising in the hundreds of millions over the last several months. These were just announced, I think, within the last month or two. Friends over at Northside Ventures, $15 million fund, investing in N+1 founders doing their second companies, and emerging managers spinning out of having worked in other VC funds. And then our friends over at Luge Capital raising their second fintech fund. Fintech has been taking a bit of a hit of late, but certainly still there is an opportunity here with Luge Capital as they were able to raise $96 million for their second fund. Something that we hope to see more of too in the M&A market. Canada did do much better in Q2. Bennett Jones, as we showed in a previous slide, indicated that we had a sizable drop in M&A in the first part of this year. Well, Q2 is where everybody was doing the deals. So we're hoping to see that this trend continues and that we end up with a strong second half of 2024. More M&A is good for the market, more liquidity, again, back into the ecosystem. We need more liquidity, and that is what Canada, and especially Western Canada, is absolutely desperate for at this point. And finally, the big trend that we want to watch here is interest rate cuts. Canada has done a couple of cuts over this year, and we're expecting to see the US make a cut here right away. And we're hoping that those rate cuts are going to continue into 2025 and beyond. If we do see that, that does open up more venture debt opportunities, also frees up liquidity for investors to be able to invest more into the ecosystem. So that's where things are at. And if you'd like to come out and see what the state of startup investing and what the startup ecosystem is like within your city, highly encourage you on a Thursday night. That's this Thursday from 6 to 9 p.m. In Edmonton, Calgary, Saskatoon, Regina, and Vancouver. There's an opportunity for you to come hang out with other startups, investors, and meet folks that are probably applying for this year's upcoming summit or potentially investing in the summit. So with that, that's where we're at with Safe Start Investing. If anyone would like to ask any questions or have a discussion, I'll end.